Stocks on Wall Street tumbling Tuesday afternoon on trade fears. The Dow down 350 points, S&P off almost 1%. Let's talk to Nick Coles. He's co-founder of DataTrek Research on this topic. Well, Nick, comments by the president denting hopes of a trade deal with China before the 2020 election. Then you have Commerce Secretary Wilbur Ross saying that, it's going to stick to its imposed December 15 deadline for tariffs on China. So what's your read into today's stock drop? Is this, an excuse for a pullback, or is this time for risk off?
Yeah, it is an excuse for a pullback. We had a very strong rally, obviously, in November, and I think the administration feels to some degree they're playing with house money. We've had a great year in the stock market. S&P's up over 25%. And so if you lose 1% or 2% because of some renegotiation or negotiating posture, that's okay. The market's still strong. Labor market's still strong. GDP growth this quarter should be 1.5% to 2%. And they feel they've got a little bit of wiggle room here.
So what happens, let's say, on the second half of that question about Wilbur Ross, what he said about the December 15th tariff deadline? If they were imposed, what would happen to the markets?
That would be a surprise to the market. The market feels very strongly that we're in a bit of a trade truce right now. And if you saw December 15th come and go with incremental tariffs, that would mean the truce was basically over, and that would cause, I think, some real concern.
So as of right now, then, you're biased towards optimism going into the year and what few weeks we have left.
Yes, for a couple of reasons. First, from a big macro standpoint, it just makes sense that the president would both try these negotiating tactics, but ultimately still want to achieve some kind of trade resolution going into an election year. And secondly, if you look at years with strong returns and strong Januaries, they almost always end on a high note in December. December is seasonally a pretty friendly month for equity holders. So put all that together, and it does feel like we should still play the pattern of December being another strong month.
So a Santa Claus rally as opposed to, say, Groundhog Day, that's coming up again because you turn the clock back 12 months from what we saw last December. We started December on the wrong footing, and today we've got this.
Yeah, no, it's a very good point, and we did some work on that. We looked at money flows and found that, look at last fourth quarter, investors were pulling money out of both stocks and bonds in October and November. December was obviously catastrophic, but you had some inkling investors were getting twitchy going into the month. We haven't seen that pattern this year. October and November have seen pretty good money flows into equity and fixed income, mutual and ETFs. And so you don't get the same sense that investors are as nervous as they were a year ago, and rightly so. Things do feel fundamentally better.
Okay, let's say you got some money on the sidelines. You want to put some money to work in the last few weeks or going into January. What would you put it into right now?
We tend to always like U.S. equities over international. We've heard a lot from clients wondering if EM is the way to play any kind of trade resolution. We strongly feel the U.S. is the way to go. Within the U.S., we like technology, the big tech names, Apple and Microsoft. And then we also like industrials because industrials look pretty fairly valued and should have an up year. And then financials are one good way to play value and a cyclical recovery in 2020.
Okay, thanks, Nick. Appreciate your thoughts.
Thank you.
Our thanks to Nick Coles of DataTrek Research. I'm Fred Kantayama. This is Reuters.